We begin with our top story, a lack of conviction behind an equity market near an all-time high.
All institutional investors I spoke to were very cautious still.
There is evidence of higher than average cash levels.
Looking at Q1, that's probably the most hated rebound ever.
They're feeling like, well, hold on, let's get some confirmation about what we just did.
This is somewhat fragile.
Negative inflows for US equity ETF during Q1, despite a very strong performance.
The US equity market at the beginning of the year, we saw outflows, but starting to come back in and finally kind of right now in the positive territory. So not as much as you would expect from a quarter that have delivered such good performance.
A flawless rally to me speaks volumes about low conviction. It seems to lack that ongoing conviction.
That would suggest that there is some missing out.
Investors have not loaded up at all.
There are some regrets in terms of having not participated as much as they would like to.
It all suggests you should be taking a bit of care before you sort of set the tone of this being a new one-direction rally upwards.
To discuss, joining me around the table here in New York is Priya Misra, TD Securities Global Rate Strategy Head, Thierry Wizman, Macquarie Managing Director and Global Currencies and Interest Rate Strategist, and Jonathan Mackay, Schroders Senior Market Strategist. So, John, let's begin with you. Why markets and risk assets have snapped back so aggressively over the last 3-4 months and sentiment hasn't caught up? Why?
Because the growth picture and the earnings picture just isn't good, right? First quarter earnings expectations for about negative 3% earnings growth based on consensus. Companies will probably beat that because you usually get a 3% beat to the upside, so maybe we're flat for the first quarter. But the full year numbers have basically been chopped down from about 11% 6 months ago or 9 months ago down to about 3.5%, maybe close to 4% right now. And you've had this multiple expansion in the first quarter, which leaves you with valuations which are arguably rich based on the growth outlook. So I think that's why sentiment is a little bit like, this is too good to be true. You can't annualize these numbers.
No, you can't. And volume through much of last week was pretty light as well. A lot of people trying to work out what's going on. My colleague Richard Breslow, Priya, saying the following this morning: markets are quiet because no one has a clue. Is it that simple?
I think to some extent, I think the market's gone from the Fed's making a big policy mistake in the fourth quarter to they're patient. But I actually think that March meeting where the Fed was extremely dovish, I think that changed the narrative a little bit. You know, are we going from this Goldilocks, everything is okay, but all central banks extremely dovish, to are they actually signaling the end of the cycle? In which case, you should be out the curve in terms of treasuries. You should be getting out of all risk assets. Now, the data that we've seen so far for March is actually pretty encouraging. I think we have the China data, we have the US data. I think if growth is actually okay, if the US is going to grow at 2% and all the China stimulus is going to finally show up in global growth data, I think then the risk rally has more room to go. We've had a pretty big run, but I would say, you know, we're still feeling pretty confident that central banks are trying to extend the cycle rather than signal the end of the cycle. What
do you think, Terry?
Well, I think to Priya's point, there has been encouraging signs in the March data, and even in the February data, at least to the extent that some of it has come out late. Sentiment surveys in Europe are a little better. We've seen the China PMIs break above 50. We've seen over the weekend the Chinese credit data be better. Even some of these tracking estimates in the U.S., like the Atlanta Fed's and the New York Fed's GDP Now and Nowcast projections, are starting to turn higher. You see Q2 growth in the U.S. now breaking above 2% on both of those metrics. So I guess my point here is that if you're looking for growth to be the next thing that supports this rally, I would agree with that view or that perspective. But I want to make an important point here. It's the foreign markets that have generally lagged, not just recently, but over the last several years, the U.S. And given that a lot of this poor sentiment really pertains to the problems outside the U.S., it may very well be the case that if we could do a continuation of this rally in the next few months, it'll be the foreign markets that do better, and the foreign currencies as well, by extension.
John?
So starting points matter, right? And to Terry's point, agree with that 100%. Would you believe that France and Italy have beaten the U.S. equity market year to date, right? Bit surprising given what's going on politically in Italy and the fiscal picture there, as well as the yellow jackets, all the, the political issues over in France as well. So I agree with Terry. Cheaper valuations overseas. I agree with Priya as well that the growth picture is okay, but we went from basically really bullish growth to we're going into a recession because the yield curve is inverted to everything's just okay and the U.S. is up here and the rest of the world is basically here.